In modern markets, every investment carries risk. Buying a stock, launching a startup, or purchasing property all involve an unpredictable future. But ethical finance draws a sharp, non-negotiable boundary. It embraces legitimate commercial risk but strictly outlaws market gambling. Today, we define the boundaries of Gharar and Maysir. While the conventional financial system frequently packages pure speculation as a legitimate asset class, Shariah frameworks enforce two distinct guardrails: Gharar, which eliminates hidden asymmetry in contracts, and Maysir, which bars zero-sum gambling games from the real economy. The goal of this lesson is not to eliminate uncertainty, because economic growth requires it. The goal is to separate legitimate commercial risk, where you back a company's real production, from prohibited speculation, where you are simply placing a bet on a number. Gharar translates to deceptive, unmeasurable uncertainty. It occurs when a transaction leaves a critical component completely blind, such as buying the birds in the sky or the fish still in the sea. In modern terms, it refers to information asymmetry, where one side holds an unfair advantage, or the contract itself is structurally incomplete. Sharia jurisprudence distinguishes between minor uncertainty, which is natural to business and tolerated, and major uncertainty, which fundamentally corrupts an exchange. If you purchase an item but the final price depends on a future index that neither party controls, you have entered major Gharar. This is exactly why naked short selling and conventional options trading are disqualified from a compliant portfolio. Short selling requires you to sell an asset you do not own or possess, a direct violation of the call rules against Gharar. Similarly, an options contract is the sale of an abstract right, not a real tangible asset or business share. While Gharar deals with contract structural errors, Maysir deals with intent and behavior. Maysir is pure gambling. It defines any financial arrangement where wealth is reallocated entirely based on chance or absolute speculation, rather than productive economic output. The economic hazard of Maysir is that it is fundamentally zero-sum. It does not create new industry, goods, or jobs. It merely shifts capital from the loser to the winner. This turns financial markets away from capital allocation for real factories and technology, transforming them into a high-stakes, elite casino. This principle changes how we look at asset behavior. If you are day trading highly speculative meme stocks or micro-cap tokens, relying completely on short-term momentum shifts, and hoping to dump the asset onto the next person before it crashes, you are no longer investing. You are engaging in behavior that mimics Maysir. Ethical finance doesn't avoid risk, it embraces it through a maxim known as Al-Ghunm bil-Ghurm. The right to profit is explicitly bound to the willingness to bear loss. When you buy a technology stock for the long term, you risk your capital alongside the founders to build a better product. That risk is not only legal, it is the pure engine of ethical wealth creation. When building an automated screener or selecting stocks for our portfolios, we must ensure the companies themselves do not hold major positions in derivatives, insurance, or gambling operations, cementing our capital to the productive side of the global economy. The rules of Gharar and Maysir are designed to protect you from structural exploitation. They force finance back to its true purpose, funding real human progress, tangible real estate, and transparent enterprise. In our next lesson, we take these philosophical pillars and turn them into data. We map out the exact qualitative filters used to screen global equities for business activity compliance. Subscribe to stay tuned, and let's keep building wealth with a conscience.